GM, good morning. Welcome to the Milk Roast Show, the daily crypto show that's as satisfying as finishing a plate of grandma's freshly made cookies. I'm your host, Jay Hamilton, and today we're analyzing the recent decline in the US dollar and discussing what is the impact that we expect that to have on markets in the coming months and why we feel like it's so bullish for your bags. Here to guide us today is Milk Road co-owner Kyle Reidhead. Now, before we jump into today's show, I just want to give you guys all a big thanks. Yesterday was our biggest episode ever, and that all goes to you for listening and for subscribing. And right now, if you subscribe to our channel by the end of August, we're going to hook you up with a chance to win some sweet prizes. Check the show notes to find out what you can win, and make sure you subscribe to our YouTube channel or wherever you're listening if you're not already subscribed. Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/kelpgain and spot airdrop gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AgETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live, and you can go check it out for yourself today. Just head over to milkroad.com/kelpgain and get started. Kai, welcome back to the show. Let me start by asking you to give us a little bit of context here around what is going on with the US dollar over the last couple of weeks. Can you explain what the Dixie is as well, just for those who don't know that term? And then let's start to talk about what we see as the impact on the crypto markets.
Yeah, absolutely. So we've talked a lot about interest rates and liquidity over the last few weeks here on the show. And this is just another indicator that helps you kind of understand what this liquidity and what these interest rate moves can do. And so the Dixie is basically a measure of the US dollar versus a basket of other fiat currencies. So let's say the euro and the yen, et cetera, all into one. And so essentially the Dixie is just a measure of the US dollar and its strength versus other countries. So when rates are high in the US and they're not printing a whole lot of money, the dollar tends to do very well, right? Because think about it. If rates are high, that means that you can hold US dollars, put them in US treasuries and earn currently today 5.25%. That's pretty darn good, right? You don't really need to take a lot of risk in the stock market, hoping you'll get 7, 8, 9% a year, which is, by the way, what most people get. I know in crypto, we want a 10x every single year, but a 10% is pretty good. But if you can get a 5.25% with zero risk, that's pretty darn good. And so when rates are high, the dollar tends to do much better. It means risk assets do much worse. It's why when the dollar is high, crypto doesn't do as well. And we'll show you a chart that shows this so clearly. But then when rates get lower, when we start printing more dollars, we put more dollars in the ecosystem, in the economy, then the dollar gets a bit weaker, right? And that means people are getting out of it because, well, I don't want to hold my dollars in treasuries when rates are 3% or 2%, right? I want to go put them in the stock market or in real estate or something else where I can get a better yield. And so the dollar tends to go down. And so over the last, little while here, we've had the dollar doing quite strong. And it looks like, anyway, the dollar is beginning to break down. At least the Dixie is beginning to break down versus other fiat currencies. And this could mean really, really big things. Now, basically, all this is saying is the same thing as we've always been saying, which is rates are coming down, liquidity is going up. The Dixie is just another indicator of that. But there are some very, very clear correlations, which we'll show you in just a second.
Amazing. That perfectly leads into the next question here. I've got a chart up on the screen of the Dixie versus the total crypto market cap. Kyle, when we look at this chart, what are you seeing?
On this chart, we're sharing the Dixie here. And every time that it goes down, and I don't mean like down like a little bit, like a percentage point or something, when it's going down big time. So let's say it's going down from 110 or 108 down to like 90 or 85. These are big, big moves in at least in currencies. And so in the Dixie, every time that happens, crypto and stocks in general go on a massive, massive bull run. So if we think of the end of 2020 and 2021 bull run, look at what happened. We had a massive drop in the Dixie. It went from about 104, 103-ish down all the way to 88. Okay. Massive move. And that was when we just went on that crazy bull run. And sorry, that was in 2017. If we do the same thing back in 2020, 2021, we went from, again, around 103, this time down to about, 90. And same thing. We had that crazy run 2020, 2021. And then if we look at when we topped out and bottomed out of the bear market in crypto back in like end of 2022, again, we had a massive run down. The dollar was up at 116. It was, or the Dixie was there. And again, that took us a massive run in crypto back in, late 2022, I guess all of 2023 was the same thing. The dollar was just breaking down the whole time. Now we've sort of ranged in the dollar for the last, let's call it for basically all of 2024. It's been up, it's been down, whatever. But if you go to the other chart, Jay, we can see that we've just sort of broken down from this trend that we've been in for the last, let's say, year or so. And if we break below that, it looks like the dollar or the Dixie is about to go much, much lower. Let's say maybe into the 90s and maybe lower. If that happens, you bet your bottom dollar, no pun intended, that we are going to go into a massive bull run. And the same thing, what's interesting is when you look at this chart, the Dixie is breaking down the same time that M2, which is global liquidity, is breaking up, right? We've talked a ton about global liquidity. They tend to go hand in hand. And so what's interesting, though, is looking at global liquidity is kind of hard. It's difficult metric, as we've talked about, indicator to find, because there's just so many ways that you can sort of look at it. The Dixie is very easy. You can open up TradingView, just Google it, Dixie price, and you can watch it live all day. And you can see that when the Dixie is starting to break down, when it's going lower, typically risk assets start to go up. There's a very clear correlation here, and we've seen it over multiple cycles here in crypto. And so the other side of the coin, too, is when the Dixie starts to do well, they call it the dollar wrecking ball. So whenever the dollar is like, hey, I'm going to go on a bull run, which happens, every 4 years, at least in these cycles, but it happens a lot in history. When that dollar goes on a bull run, it's very normal to call it the dollar wrecking ball. You'll see back in 2022, when we were in that bear market, there's so many videos on YouTube called the dollar wrecking ball. And it was the same thing. It was the dollar was going up, and so risk assets were out. Everyone's leaving risk assets and going into the dollar. We talked about it actually back then on the pod. And so obviously we're going the opposite way of that right now, which means we're very bullish, but it's a great indicator to just watch the Dixie and see what happens. Because if this thing breaks and continues, now obviously it's down below that trend line that we just showed on the chart there. It doesn't mean it's going to confirm that. But if it does, and we start to see it going below 100 down in the 90s, this is going to be very, very bullish. And this is the banana zone we always talk about. Just another indicator to understand that.
This obviously feels good. What do you think when you project this out? As you said, Dixie trending down. What does this say to you about the US economy and how they will respond and how this will impact the markets?
Yeah, I mean, the Dixie is kind of you could think of it a little bit forward thinking. Like, we haven't lowered rates yet, but the dollar's already starting to break down. Why? Well, it's because we got to wait till September for the Fed to lower rates, but everyone's pretty convinced that it's going to happen. And so people are already starting to put on that trade. They're moving out of the dollar, getting into risk assets to get ahead of what is about to happen here with interest rates, right? So it's just a clear sort of forward thinking indicator, I guess, on what's going to happen with rates, what's going to happen with liquidity. And so as we see the dollar break down, it's pretty obvious to me that risk assets are going to do well. It's that banana zone we're always talking about. Again, it takes time. The Dixie and currencies, they move slow. So like, just because it's broken down that line. In crypto, when we break a trend line, it's like tomorrow you're down 20% or you're up 20%, depending on the way you broke out. It's not how it works in Forex and in currencies. So like, this is a long, slow trend line. It'll take probably 12 months, 6 months, whatever it is, for this to break down and get all the way to the 90s, right? Hopefully, if it jumps all the way down to the 90s tomorrow, you bet everything's blowing up and it's going to be a big problem. So we're going to hope this is a slow decline down, which it generally is. Again, if you look at the charts we showed, it takes time for these to unfold. But it looks like that's the direction we're going. We'll see what happens, though.
If we step back, what does this mean for the U.S. economy? Does this mean that this could push the U.S. economy into a further recession? And if so, how do they respond?
Yeah, I mean, I don't know that the U.S. is going to go in recession. I think we talked about this last week of, are we actually going to go in recession or not? I feel like that was just like that 1 week where everyone was just kind of losing their mind after the yen carry trade unwind. Everyone was like, okay, we're going to recession. Everything's screwed. We're all messed. And it feels like even just a week from that now, people are kind of like, maybe we're not going to be in recession. It's actually all not that bad. And so like, I don't know that we will go in a recession, to be honest. I don't know that we can go in a recession. And there's a few reasons why I believe this. Let's sort of talk about was it last week or 2 weeks? We talked about boomers and how inflation works and all that kind of stuff. I think it was last week,
2
maybe
weeks
2
ago.
weeks ago now.
2 weeks ago.
So people always ask, why do you have so much conviction that global liquidity is going to go up and interest rates are going to go down and the dollar is going to go down and we're going to go into this bull market? I've been saying it for forever. I think Lark says it. A bunch of people on the show say it. Why do I really believe this? I mean, one, you can look at the charts that just showed you. It kind of looks like that's what's happening. But in my opinion, even with all the bad news or the scares of maybe we're going to go to recession and this isn't going to happen, I just don't think we have a choice but for this banana zone to happen. And there's sort of 3 reasons why I believe this. One, I think the US has to lower rates and print money. I just don't think there's any other way around it, which automatically just weakens the dollar and lowers the Dixie. And I think the reason that they have to do this is, one, if we look at the interest payments that the government has to pay on their debt, remember the government is trillions of dollars in debt, right? Or the Fed. And they also have to pay interest rates on that 5.25%. It's not just us citizens that have to, our mortgages go up, right? And our loans on our credit cards and our cars go up. This happens to the Fed and the government as well. And they are a lot more in debt than any of us are. At least I hope so. And so there are tens of trillions of dollars of debt. And so if you look at the debt payments on just interest, so this isn't anything to do with paying back the principal of the debt, but just interest payments, it's $1 trillion right now. I think, what is it, quarterly or is this annualized? I can't remember, but we're over $1 trillion right now. In Q2 2024, we're 1.089. Okay. And that's trillions of that they have to pay in interest payments last quarter. And that's going up massively. And that's happening because rates are so high. And so they literally can't continue to keep rates as high because they cannot afford their own debt. And so that's one metric that just shows you they have to lower rates. There's nothing they can do about it. Not only do they have to lower rates, they also don't make that much money. So they also have to print money. So you already know that just for them to do that, they have to do it. Now, if they went into recession, imagine what this does to that number. So they have to pay $1 trillion in interest payments. That doesn't even count their principal, plus all the other crazy government expenditures that they have to pay for. How do they pay for that? Well, the government revenue comes from what? Taxes. And you get taxes in sort of 3 ways. Let's say income tax, spending on goods and services, and capital gains, right? 3 taxes. It makes up from this chart here. 93% of all revenue of the government is from those 3 things. What happens when you go into a recession? Well, unemployment goes up. And if it goes up too much, you have a bunch of people that aren't working, which means they're not making income tax. And so there's a big hit to the revenues of the government. Okay. When you're in a recession, people stop buying things. And so there's another hit to their revenues. And then the last thing is, if you let markets go down, so if markets go down big time, let's say the stock market goes down, I don't know, 50, 60% like they did in 2008. Well, now your cap gains tax, which is also a massive amount, right? Companies and people selling their stocks and making money on that. That's a huge revenue driver of the government. If we go into a recession, all those things go down massively. And so their revenue goes down huge. And so they have no choice but to pump markets so that we don't go into a recession, which is why we haven't been in one since 2008, because the government realized we could just print our way out of this. Okay. And so their interest payments are too high. And so they need to lower rates as is, and they're going to need to print money to pay for that. And then you have a third one, which I think is probably the biggest. And if we think about the way the world works right now, it's funny. It's kind of, we'll go off of our story of back when the boomers were entering the workforce. Let's talk about the boomers now leaving the workforce, right? So around 2000, and I guess it was 8, I think, the boomers started to get to the age of 60, where they started being able to retire. And what happened is, at the time when they were all working, the government started this idea of a pension, right? If you guys pay a little bit of your income every month into this pension thing, we'll invest it for you. And over time, it should grow. And then you can retire. And then you can just take a bit of money from your pension every month. And that's how you'll make your income. So you don't have to work when you're 60 or 65 or whatever age it is. Okay. So great. It's worked for a long time. But all of a sudden, the largest demographic in the world back in around 2008 started retiring. And over the next 10, 15 years, they all retired. Not all of them, but a lot of them retired. And so the amount of people that we have that are not working in this world, at least in the US, is massive. Okay. And the only way they make money, at least most of the ways that they make money, are 2 things. One, their pensions. And then they have, usually most boomers bought real estate. So they own real estate. That's where all their savings is in real estate, their home. And then it's in their pensions, which is basically the stock market, right? So whenever you put money into your pension, they're essentially investing in the S&P 500 and like kind of spreading it across the economy. And so if you think about this for a second, the entire savings of the pension for all the people that are retired right now. So basically, if they don't have this pension, they don't live, because they can't buy food. They can't pay their mortgage. They can't pay whatever the heck they need to pay for it, right? And so all of it relies on pension, which all of that relies on the stock market. And so you start to think here, can the government really let the stock market go down 50%? Absolutely not. Because if the stock market goes down 50%, the boomers have no more money left. What are they going to do if their entire net worth goes down 50% from this like crazy recession or a big sell-off like we had in 2008? I just don't think we can do that anymore. Back then, it wasn't as bad because everyone was still working, right? And the debt wasn't as big. The interest rates weren't as high. The interest payments weren't as high. But now it's like there's just so many things saying we cannot let the market go down. We cannot let our world go into recession because the whole system breaks if we do that. And if boomers all of a sudden can't get access to their pension, or also you think about they leave interest rates high, the real estate market is getting crushed, right? If we're not printing money, lowering rates, all of a sudden their house is not worth anymore. And they don't want to sell their house because they're not going to make any money off of it, right? There's no one there to buy it anymore. And so the government actually has almost like a mandate to make sure that the stock market continues to go up. That's why this is such a good investment to just invest in the S&P 500 or the NASDAQ or new tech like we want crypto, which is the fastest horse, right? So if we start to think about this, I don't know that we can allow there to be a recession anymore. I think it collapses the entire system. And I don't mean like a short recession or a small one. It could probably be fine. But a 2008 like recession where the stock market goes down 50%, I just don't think we can do it. It's just not going to happen. There's just no way. And then on the other flip end of it is like, we also can't let the dollar spiral out, right? So they have to just keep printing money to pay for their debts because they can't default. If they default, the dollar becomes useless. And then we go into hyperinflation and like goodbye US economy. So like our only option is we have to keep printing money. And so when people say, how do you know that there's going to be another bull market? It's because there's just not another option. The only other option is a complete disaster and a global meltdown. And there's just no way that any president or Fed chair is going to ever let that happen. So there's two sides to the story. Either we have a global meltdown or you get the banana zone, your choice. And I'm telling you right now, especially in an election year, the president, the Fed chair, they're going banana zone every single time. And so that's how I bet the system.
It sounds so obvious when you say it like that. It's a house of cards and
right.
It's a system that is so fragile and their only way is to keep building on top of the house of cards because they can't let it all fall down. And as you said, affect all of these people that rely upon their pensions in order to live as they are retired. What do you think what do you expect to happen over the next few months? Like, is there a trigger that you're looking at? What are the timelines around these next moves up that you think could come? Because you did say the dollar does move very slowly. This isn't an immediate thing. Yeah. Is this going to be a slow event?
I think I don't know. If you look at the chart right now, the Dixie, it's been collapsing pretty big over the last little while here. Now it's done it a few times in the last like 2 years. So we really need to see it break through, but it is like, I think we're sitting at 101.1 right now. And we were 101.4 or 5 just the other day. And crypto is up big time from it. We're up 4% on Bitcoin and 3% on ETH right now. So it's reacting to the Dixie. And I think that's going to be the trend over the next little bit. We were so inflation heavy for a little while there. And then we were looking at liquidity. I think you're going to hear a lot about the Dixie over the next little bit if that starts to come down, because if that starts to come down, markets just change completely, right? It's such a big deal when the Dixie comes down. It's just because the dollar is the global reserve currency. It's kind of in everything. It's in every ecosystem. It's in every country. It's all around the world. And so when the value of that thing moves over, let's say 6 months, a large amount, it changes a lot in terms of imports and exports, in terms of how markets work. And so I think it's going to be the big thing that really moves markets right now. And if this thing breaks and continues to go down and we see the Dixie break 100, I think the banana zone's starting. So we'll see what happens. I don't know how long it's going to take to get there. But I think we just had the Fed minutes are coming out, whether it's today, I'm not sure, but I saw some stuff on Twitter just before we started recording of it looks like the Fed is pretty much in agreement that they're cutting in September. And so I think we're going to hopefully front run that, and September is going to look pretty good for us. The only thing that still makes me unsure why I wouldn't like go long on my longs is because of the election. Harris seems to be very anti-crypto. And so that's getting a lot of people pretty sketchy. There's talk about her, I don't know, increasing tax rates and all these things that just people don't love and generally don't do so well for the stock market. But I mean, I think it's going to be fine. I don't really care who wins. I think either way, we're going to go into a banana zone because we just have to, as I just explained. But I just think that worrisome there leading up to November 6th could just hold us back from going full banana. But I think I love saying it. It's so much fun. But I think, I don't know. I think September's been pretty good as long as we see this Dixie continue to go down. So all eyes on Dixie right now is what I think.
All eyes on Dixie. The US can't go into a recession. The banana zone is inevitable.
Banana zone is good. I hope we at some point it's I don't know. It's kind of fun actually. The banana zone is actually a lot of fun. So I love it. You know what we need? We got to get through the boomers, man. This whole thesis that I have is all around the boomers going through life. They've just changed markets so much. And who knows what's going to happen with our pensions, by the way. If you're like 20 and you're hoping for a pension 40 years from now when you retire, you need a backup plan, which is really what crypto is, and getting in before the banana zone. This is why we are so adamant about not fucking this up, because if you want to buy a home, like it's so hard to do that coming in as a 20-year-old, even 30-year-old shit. It's hard, right? Unless you are making a shit ton of money, which is not that easy to do these days, unless you run your own business, right? So it's really tough to catch up and get in on these markets because real estate's just so expensive now and it climbs so fast, which is again, as a result of these markets. And if you think you're getting your pension, like I don't see it. I don't know how that's going to happen. Now, I'm sure something else will come in, some sort of like UBI that hopefully comes because of crypto. I don't know. So I'm not saying this. I'm not a doomsday guy saying like you're fucked 60 years from now or 40 years from now. But if I'm young, I'm learning to invest first thing because like I'm just not trusting that I'm getting this pension because I don't see how we can pay all these boomers. Because the other problem is, the boomers generally, back in the day, you would retire at 60, you'd die by 80. Now they live till 90, 95, 100 because we have all these medications that just keep people alive. You know, we're just a bunch of zombies out there at 90 years old. And so like that's taxing on the healthcare system. It's so expensive. And like, I'm grateful for it, right? You get to be with your family and your grandparents much longer, but it means a lot more debt. And so it means more printing and it makes for a mess in the system. So you need to, I can't stress enough that you need to take advantage of these banana zones. It's short. Like, let's say the banana zone starts in September or October. It lasts till like, I don't know, if we look at last cycle, we really took off. And I think it was October, maybe November of 2020. And if you don't count the second sort of like peak that we had in crypto, which was like, the first peak, Bitcoin hit 64K. The second peak, it was like 69. So it was like, whatever. And it was all propped up because of FTX. And so like, it was like 8 months, you know? From November to like May maybe or whatever. Yeah. What is November to May? So like, it's not long. And so if you're not allocated before that, you're really going to miss out.
Kai, I didn't even have to ask you a question at the end there. You just went on a great rant. Everybody listening again, tell me if, maybe we should just have more shows where Kyle just shows up and goes on rants. And I just sit here and listen. Yeah. It's all on your own, a cappella. Everybody,
Jay, you got to learn to play violin, and you can just like stream along a nice little violin for me.
The violin.
And, the violin, if you can. And then I'll speak to the violin.
I cannot. Definitely not.
Any instruments? Can you play anything?
Not well.
Okay.
Not reliably well at all. I could have a good conversation. That's all I'm good for. No musical gifts here. I'll hit the dance floor though. Everybody that's listening in, I want to remind you one more time. If you subscribe to our show right now, by the end of the month, you can win some really cool prizes. Check out the show notes to learn more about what you can win. We're giving away hundreds of dollars in prizes, and it also helps the show huge. Also, let us know what you thought about today's show. Give us a review, give us a like, give us a comment if you want us to talk more about the Dixie. As Kyle said, something that we think we're going to be talking about more in these coming weeks. Keep you guys updated, but things are looking quite good. Remember, none of this is financial advice. Investing in crypto or any asset is risky. Do your own research and only invest what you can afford to lose. Thanks so much for listening in, everybody. Have a wicked awesome day.